Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Report coming to you once again from Central Florida on a lovely Sunday afternoon down here. Not much really changed in the market over the course of the week. The markets have a very small fractional loss, about 3.38%. So not an enormous amount of movement. The All World Earth Index, URTH, was basically flat for the week. So all the same concerns are still out there. Lack of revenue growth in corporate America is really concerning to me. Of course, the Ukrainian situation is far from diffused and probably won't be for quite a while. That's going to weigh over European markets, potentially spilling into the domestic markets here in the U.S. as well. And of course, you have the always ongoing fear of higher interest rates for traders and investors to deal with. Creates a lot of noise, doesn't really mean a lot to us in the day to day, but it's there. It's going to continue to play out. Now, this week, I'm going to do something a little different. I usually talk about what I think about the markets and what's going on, but honestly, all of you should have gotten a link to the James Montier piece, the interview with him, where he flatly states equity markets are overvalued. If you have not gotten that, shoot me an email and I will send it out once again. If you read that, you'll know everything that I think about the stock market in here. There's nothing cheap to buy, and that's the major indice. Set everything else aside, there's not very many cheap stocks out there. This week, I want to do something a little bit different. The reception to our March Madness campaign has been really strong. We've got a lot of new subscribers out there, and I imagine we've got a few that are still kind of thinking about it, wondering whether they should show up. Now, if you haven't been around with the value portfolios and listen to some of the terminology and phrases that we used and introduced in the early webinar broadcast to introduce it, sometimes you might not have a clue exactly what it is I'm talking about. So want to go over everything that's in the various letters, what you should expect, what you're going to get, and what some of the terminology means in each issue that we use. Okay, let's kick it off. The deep value and the international deep value portfolios all focus on safe and cheap stocks, clearly one domestically, one internationally. Those newsletters come out once a week. Wednesdays, I will send out the International Deep Value update, and that gives you an update on what I'm thinking about the market, what's going on with the stocks in the portfolio, and what direction we're going to be taking in the days and weeks ahead. Highlights anything that I found interesting during the week that I think that you need to know about. Deep Value's weekly letter comes out on Friday afternoon. Both International Deep Value and Deep Value also get a weekly reading list. And this, don't downplay this. This is probably one of the most important part of the subscription service. Each week, Saturday morning for Deep Value, Wednesday night for International Deep Value, you're going to get a reading list. I'm a voracious reader, guys. I read everything that I can possibly find having to do with markets, stocks. I do a lot of recreational reading as well. Whatever I've seen in that 5-day period that I think is of interesting and value for you to know about the markets, about the geopolitical situation, new research and academic studies that have come out during the time period, just anything that I think might be interesting. You're occasionally going to get a book link to something I thought, was just a really good read and you might want to check out. Baseball stuff will make its way into it from time to time. I can't help myself pretty much. That's a critical part of the service. The reading list helps you develop that private equity, deep value mindset and learning to look at the world in different ways. So I think it's a very important part of the service and you'll really learn to enjoy it. I know some of our current readers tell me it's their favorite part. In the letter each week, I will update you on what stocks I think are buys right now at the current price and which ones are holds. Now, a stock that's a hold is simply one. It's not cheap enough to buy right now, but it hasn't hit our target price to sell either. There's some stocks, I think there's 4 or 5 each week at the current time that really are. They're holds. You don't want to sell them, but you probably shouldn't buy them at this level either. Which brings us to one of the most important parts of both deep value and international deep value. That is the fact we use a 3-price approach when we evaluate a stock. Every time I look at a stock, I calculate three prices. One's tangible book value, usually abbreviated as TBV. Okay, we like to buy at 85%, prefer even lower than 80% of tangible book value when we initiate a position in the stock. That's our first price. The second price is the liquidation value of the company. That is the number that I think represents a rational, orderly liquidation value of the company if everything was sold at a reasonable price and returned to us, the investor. That's the price where I am willing to add to the position. So if I buy a stock at 85% of tangible book value and it trades down to its liquidation value, I'm going to add. If it goes to a discount to liquidation value, I might add some more. So, and that's all contingent on passing our credit test, which I'll address here in just a second. Now, the third price is the ongoing intrinsic concern value, and that's what the rational value of the company in a normal market to a rational buyer might be, what the company is worth as an ongoing concern. Now, we're deep value guys. When it hits fair value, that's our sell point. Now, it can take years to hit that number, as if the company is succeeding and it's turning around, getting its operations back on track, that number is going to go up every quarter because it's based on things like free cash flow, asset value, earnings, operating earnings, all things that are going to continue to grow. That's the perfect situation where you get one of these where the ongoing concern value just keeps going up year after year, and it takes a long time for the price to catch up to it. But anyway, that's our target price. You'll see that often abbreviated as OGIV, just so you know what it is. That's the ongoing concern intrinsic value. Okay, so we have three prices. We buy at a discount to tangible book, we add at liquidation value, we sell at ongoing concern value. Everything is contingent. It's not enough to be cheap. You got to be safe and cheap. Okay, so we use a credit and fundamental model. It has 15 scoring points. Stocks that score between 1 and 7, we're not going to buy. There's no margin of safety in the shares at this point in time. Between 8 and 12, we're going to do the dig down, the drill down, make sure that we're not missing anything. There's no flaws. If it passes that, we're a buyer. Now, between 12 and 15, I've been doing this a long time, but if it's between 12 and 15, it's bulletproof. It's incredibly safe. It's cheap. We'll do a little bit of reading, but we don't have to feel like we have to dig as deep. Okay, this is a bulletproof stock. We're just simply going to buy it if it trades at the right discount to tangible book value. So that's the credit score that you'll see, and it's often referred to as the CNF score in the spreadsheets and articles that we'll send out to you from time to time. Now, if we have a stock in the portfolio, say it's got a credit score of 8, and it slips down to 5, that's a sell. If it's rare, it's extraordinarily rare. But when if it slips all the way down to 5, it's heading down into the financially distressed level. And at that point, as stockholders, we're not that interested. Now, the distressed bond guy side of me might start to get a little peaky on that, but we're not going to hold the equity. It's too risky. There is no longer an adequate margin of safety to hold the stock. We're blowing it out the door. So anyway, I do provide portfolio allocations. I'm very much a Walter Schloss kind of guy, 1-2% positions. Occasionally something will grow into a 3 or 4, but it's pretty rare. So in times like this, when there's not a lot of cheap stocks, we're holding a lot of cash. Now, I'm often asked, can I use just the portfolio without your asset allocation? Of course you can. I'm a newsletter writer, not the principal. If you want to take the 30 stocks that are currently in the portfolio that I hold at 1%, bump them all up to 3%, feel free. You're going to kill me in an up market. You're going to earn a much higher return than I would in an up market because our stocks do extraordinarily well. Our individual stocks are beating the market handily since we started the newsletter service back in July. But because we're only about a third invested, we're lagging a little bit, as I always do in aggressively rising markets. Not too concerned about it. I'll get my day. So yeah, feel free to fiddle with the asset allocations. Just be aware that you're dramatically increasing your risk portfolio. Now, you also continue to get the weekly value view that we send out to pretty much everybody, as well as these weekly videos. Those will come in. You have access to me through the email and messaging systems. And the one thing I promise you is I will always answer you. If I have not answered you within 24 hours, something's gone wrong with your email, or I got hit by a truck, one or another, contact me again. I'm usually back to you within 24 hours. If it's real, but often I'm back to you within a couple minutes, and I try to really do that. It may just be a one-line answer if I'm really busy. For instance, on most days that end in Y, I'm kind of a little busy, but I will get to the heart of your answer, and I'll answer it. If you have more questions, just keep following up. I do not mind questions. I like them. I like the engagement with readers. In fact, just tossing this out there, I'd love to hear some feedback on this. I'm thinking of starting to do a weekly Google chat where we can just do one of those Google Hangout things and all get together and talk stocks, baseball, wine, barbecue, whatever it is we want to talk about. And maybe do that, on a Tuesday or a Thursday evening, just kind of hang around, talk stocks on the internet for a little while. Let me know if you're interested, and I'll get that put together. So anyway, one thing we added about a month ago to both DeepValue and International DeepValue that I'm really excited about. I think it's worth the price of the subscription, and that's the Resource Center. Now, that's all the stuff I've run across in the last 28 years of doing this that I think is evergreen in nature, having to do with value investing. It's interviews, articles, research papers, tools such as stock screeners and stock evaluation checklist. There's also some ebooks in there. There's a PDF of margin of safety in there that I ran across on the internet. There's a link to that, which is pretty exciting. That book sells for $1,500 in hard copy these days and has been out of print for years. It's one of the most important investment books ever written. So there is a link to that in there. It's a link to tons of great academic studies that evaluate, value versus growth investing. I think you'll find it just to be a tremendous resource that makes you a better investor. And that's kind of the point of all this anyway. So the Resource Center, we just added its international DeepValue this morning. So that's now available to both of those products. Now, I also want to take a minute and introduce you to a fella by the name of Mr. Womack. Some of you who have not been around reading my products for a while might not know who he is. Mr. Womack was introduced to us by John Train back in 1978 in a Fortune magazine article. He was a pig farmer who had never lost money in the stock market and never did through the balance of his life. Real simple approach. When he was out on the farm, and remember, this was pre-internet and all the mass media that we have today, and he saw in the news and read in the paper that stock prices were imploding, the world was ending, the picture was dark, and it was awful, and nothing good was ever going to happen again. He would drive into town to his local broker. He would buy a package of stocks, and he would go home. And he would, buy just cheap little companies, trading cheap on earnings, whatever, trading 4 or 5 year lows. And he'd go back to taking care of the pigs, and I think he raised a little rice as well. 2 or 3 years later, when he saw in the evening news that everybody was excited about stocks and they were a buying frenzy going on, he would drive back into town, sell his stocks, and go home. Wasn't day trading, wasn't worried about all these, quarterly earnings reports. He bought them when the market collapsed. He sold them when the market had a sustained rally. He always made money. He's been like my guiding light for how to deal with the markets and market timings for years. Buy maximum pessimism. Mr. Womack is probably the best example of that. I talk about him a lot. So now you know who he is, and you won't be sitting there scratching your head going, who the heck is Melvin talking about with this Womack guy or the Womackian philosophy? Now you know. Now in the DeepValue portfolio, we added a bonus. We started an income letter for folks who are just primarily concerned about earning income off of their investments. And we'll touch a little bit more on that portfolio in a couple minutes. But I want you to know that this portfolio and all the commentary on the income letter is provided at no extra cost. It's just part of the DeepValue service. Kind of my value is if I introduce new stuff that I'm going to sell to other people as a subscriber of the DeepValue letter. If we do a book promotion that we make available for sale or anything like that, or we add some fancy little portfolio tricks, you're going to get those as part of your subscription. Okay, so that's very important for you to know that. Okay, that covers DeepValue. Let's move on to banking on profits, because this is a very specialized service. It's kind of a little more of a standalone product. This only deals with the trade of the decade that I see developing in community bank stocks. The small regional community bank stocks are extraordinarily cheap. They're trading well below, in some cases, tangible book value. They've rebuilt their balance sheets. They're in great shape. It's going to be a huge merger and acquisition wave. I talk about this all the time, so I won't beat a dead horse on this one. But what you get with the Banking on Profits letter is the same thing. Instant access to me, weekly newsletters, flash updates if we do any buying or selling during the course of the week. If there's an important news event, we'll get it right out to you. But just remember, I'm a DeepValue guy. There's not much that happens day to day that I think is critically important. Most of the news will come to you as part of your weekly reading list. You get a it focuses a little bit on markets, but it's much more bank stock specific weekly reading list that will come out every Saturday morning. The banking weekly update will come out on Friday evening. So anyway, of course, you get the portfolio, the stock picks. We're about 65% invested. Like I said, if you want to be more aggressive than my asset allocation mix, please feel free. Also know that every week, and I forgot to touch this with the first two, we're going to break down, and I'll give you the 5 cheapest stocks each and every week. If you're just starting to put a portfolio together, work from that list up. you'll get a spreadsheet about once a month that'll come out, and it'll show all the book value for all the various stocks. You start from the bottom, work your way up until you're comfortable with the amount that you have invested, okay? We'll also give you the specific buy and hold advice. Again, some of these things get up to the point where they're a little too expensive to buy, but we're not quite ready to sell them yet either. Those are the hold portion of the portfolio. The spreadsheets come out about once a month. With the DeepValue and the value products, it'll give you the liquidating value, the tangible book value, the current dividend yield, the ongoing intrinsic concern. With the bank product, what you're going to see is tangible book value. We consider that to be the most important metric. Then the other two things that we found are critically important in evaluating community bank stocks are the equity to asset ratio. How much equity do they have supporting how many assets? Banking is inherently a leveraged business model, but we don't want to be silly about it, okay? We prefer equity to assets ratios of 10 or higher. The portfolio average right now is actually about 12. And then non-performing assets, obviously we want that number as low as possible. But those are the three factors that are most important when evaluating smaller regional community banks. So we're going to provide those for every new buy, and we'll give you an updated spreadsheet on that about once a month. So, and again, if we add on any stuff that's banking related, or we do an ebook that we're selling, no matter what the topic, you're going to get that free as a subscriber. I feel like if we add stuff, you've been a subscriber, you've been following our stuff, you should get that. So if we do add on stuff, you'll get it for free, especially if it concerns the banks. All right, now the income portfolio, touch on this very quickly. This is a different duck from everything else that we do. We try to stay as fully invested in this portfolio as humanly possible. The whole idea here is to obviously earn income. Hard to do that at 50% in cash. What you have to understand as an income letter subscriber, you're going to see a little more price volatility from month to month, week to week, because we are fully invested. That's a great thing in a rising market. It's a little uncomfortable in a falling market. However, if you treat this as you would a long-term income-producing investment, you'll be fine. Those day-to-day, week-to-week, and even month-to-month price fluctuations won't matter that much as long as that income stream is coming in. We've picked safe and cheap stocks. We do loosen a little bit on the valuation criteria in our search here because we're concentrating, remember, high-yielding alternative investments matched with dividend growth candidates. So we use things like the Graham number, and buying stocks at the discount to that number. We also use enterprise value to EBITDA and a few other things. A little less stringent absolute criteria, but still safe and cheap stocks. You do get the weekly newsletter. You do get the same instant access to me. It's a lot of stuff like the Resource Center and the add-on promise that if I add a new product, you get it for free that are not included in the income letter. However, you can get all that by upgrading for just not very much money, really, to the DeepValue product, and then you get all that plus the income portfolio. So, all right, that's kind of what we offer here. Oh, by the way, it's been pointed out to me, I am a horrible typist. Now, I type all the letters, all the information that you get. I have no staff. It's just me, unless you count the cat and the dog, in which case we swell up to a staff of 3. However, none of us are very good typists. I, in particular, am horrible, and I'm a lousy editor. I'm a pretty good stock picker. I think I'm a decent enough writer, but not a good typist, not a great editor. So you're going to see a few typos, and I'm going to apologize in advance. And I thought long and hard about this, and I can either hire an editor, which just opens up a whole new can of worms. The dog and the cat don't need health insurance, and the editor would. So that'd be a pretty expensive proposition. So instead, what I'm going to do is we're going to have the Tim Melvin typo contest. Each week in the weekly letters, I promise you there will be a typo or two. Whoever finds and points out the most typos in a given week is going to win a prize. So make it a little bit of fun. Also make sure that you're actually reading the content that I send out there every week and staying on top of things. Some weeks it'll be a book that I found that I run across that I think is particularly interesting. Most weeks, I think what we'll do is we'll give away one of these very rare, very special "What Would Womack Do" t-shirts that I had printed up just to remind yourself to think like Mr. Womack and try to buy the point of maximum pessimism. So each week, if you find a few typos, send me a quick email. Let me know how many are there. Maybe you get a free t-shirt out of it. Anyway, that's our wrap up. Kind of give you a little bit of idea of what all goes into the newsletter and what you can expect from it. Anyway, as penance for all the baseball I plan to watch next week, the wife and the youngest and I are heading over to Epcot for the garden show this bright Sunday afternoon. So I'm going to go over there and maybe sit my way around the world and check out the fabulous garden displays they've put up over there. It's always a fun time. Anyway, this is Tim Melvin coming to you from Central Florida. Have a great week, everybody, and we'll talk soon.